Hello folks, this is Vinny speaking, and this is The Compound Show, a collaboration podcast presented by Vinny and Raf with the goal of breaking the stigma around one's finance. Hey Raf, how are you doing today?
Doing great, man. Thanks. Excited about episode 2 and feeling really good. What about you?
Feeling pumped too. Okay, so the audience has already had some time to review their expenses and hopefully cut back on redundancies, right? If you didn't, then you have some homework to do, I'm afraid. So please go back to our previous episode on habit costing and analyze your own expenses and finances. That will pay off massively. So today, we will talk about how to invest that money by exploring different options, won't we?
All right.
So the first point here is fixed return assets. The most common fixed return asset is bonds. What are bonds? So you can either buy public or private bonds. Private bonds are usually offered by banks or large companies. The premise there is that you're lending to these private institutions for a fixed return on your money. So have you ever done that, Raf? Have you ever actually lent your money to a bank or the government?
Absolutely. So I'm not sure how much into detail we went on the last episode on this, but basically the first type of investment I've ever made was through private bonds. That was actually done through an ETF. So basically it was just an investment fund. But basically within that portfolio, I believe, 3/4 of it or something like that were geared towards private bonds. And let me go back to you with a different question then. Can you explain a little bit in detail on how you do that nowadays? For example, you have a bank, you want to invest $1,000 in bonds. How easy or how difficult is it to do that?
I mean, this is pretty easy. Every single bank offers the opportunity to either invest in public or private bonds, right? So the difference there is that public bonds are offered by governments. It's considered a safe investment than private bonds, as you can only miss out on your investment if the government goes bankrupt.
And I guess the same applies for companies, right? I guess that the likelihood of a company going bankrupt is just,
Yeah, what you're saying is right. So conversely, in private bonds, the probability of the company going bankrupt is a lot higher than in the government. So for instance, in 2008, a lot of banks went bust and whoever was holding their bonds ended up holding the bag, figuratively speaking.
All right, so basically, if I want to invest $1,000 today, how quickly and how easily can I do that? Can I just go to my bank app and do it? Or how do you go about doing that for those listening to us that haven't quite had that experience yet?
Yeah, I mean, it's pretty straightforward. So if you have your account in the bank, you can go look it up on the mobile banking app, and there should be an option there for you to start investing in fixed return assets. You'll be able to select either public or private bonds, and you can go straight away and start the savings account today that is being invested into bonds. Now, if for whatever reason it gets confusing in your banking app, you can always call up the bank and speak to your manager directly and ask the question on how to start doing it.
Sweet.
There are also brokers where you can do the application with usually fewer fees than your own bank, and you can open your account with those brokers. The most well-known brokers are Vanguard and Fidelity worldwide, but wherever you are, there should be a few excellent brokers for you to open your account and pay fewer fees.
Absolutely. It's really important to look into that because fees will change from broker to broker. There's always going to be more of an advantage of doing it with a specific one or even sometimes with the bank itself, depending on where you are. And I guess the reason for the question earlier is that, we're living in such an age where it's just easy to do that, where in the past, it used to be a process where maybe, only if you had a huge sum of money or a great relationship with the bank, that'd be something that you'd be able to do. Don't know if I'm talking 30, 40, 50 years, but we're going to cover a little bit of that later on how easy it is for you to invest your money intelligently today. And this is just one example of that, right?
Yeah.
Okay, all right. So we're talking about, going back to the point here, fixed return assets. We talked about bonds specifically. You gave us some examples of public and private bonds. Anything else we want to add on to that?
Yeah, I think whenever you think about bond investing is commonly referred to as a negative art, meaning that your objective is to pick not necessarily what the highest return bond is that will be paid to you, but actually an institution that will not fail, so that you ensure that you will be paid as per your agreement listed in the bond.
Interesting. But as we are diving deeper here into bonds, for instance, as these are, papers issued by the bank, how can we easily define what they are for our listener here? So basically, what's a bond? What are you actually purchasing in reality?
So a bond, what you're purchasing is a promise. So with a bond, the debt owner of the bond will issue a paper saying that they will pay you back. But they will pay you back with an interest. And the reason why is because money brings money. So every year there's an inflation that burns up the value of your money. And interest is the additional payment that is paid for someone to borrow money from you. So if you're gonna go through the hassle of lending money, and there's a probability, even tiny sometimes, that someone will not pay you back because they're gonna, flee the country and not pay you back.
Never know.
So that is the interest rate. The interest rate equals inflation plus the probability of you losing your money plus appreciation of assets. So public bonds, in a nutshell, are offered by the government. It's considered a safe investment in private bonds, as you can only miss out on your original investment if the government goes bankrupt. Conversely, in private bonds, the probability of an institution going out of business is higher than in a government. For instance, in 2008 crisis, a lot of banks went bust, and whoever was holding their bonds ended up holding the bag.
All right, so I guess if we're looking at private bonds as more likely to go bankrupt based on the company profile versus a government profile, is it still fair to say that it's still very unlikely for that to be the case? What I mean by that is we're trying to, educate our audience here of different types of investments that they can make. And as we are saying that bonds, whether they are private or whether they are publicly owned, they are a great alternative for a greater return on your investment. I guess the idea here is that, you're still likely to get your money back in most cases here. We're not talking about a high likelihood of, you investing in a company that's going to go bankrupt. Is that right?
Yeah, absolutely. So the risk of bankruptcy, it's usually quite small, but whenever a crisis comes across, then you have that risk.
Yeah, I feel like it's just important for us to make sure we're clear on that. We don't want to scare anybody away into thinking that, you pick the wrong company, it's going to go bankrupt, say bye-bye to your money, that kind of thing. All right. Anything else we want to add to that, or is that basically it? It's not very complicated, is it?
No, not very complicated at all. Actually, let me clarify that the bonds are usually one of the safest investments there are out there.
Absolutely. All right. So that's, I guess, the point we wanted to make out here. Guys, if you ever want to know anything more specific about bonds, you want us to go further into this topic, please let us know. You can send us an email at any time at thecompoundshow@gmail.com. Okay. Vinny, let's move on, shall we?
Let's do it.
All right. So did you want to talk about any other type of investments we can make here for the second topic today?
I feel like now we can move on to variable return.
That's interesting. I feel like I can learn a whole lot about that. Let's do it.
Right. So the most common one that everybody knows about in variable returns are stocks, right? So the thing to realize here is that you're buying a piece of the company. So in the long term, however you cut the data, it's really clear. Stocks are the best returning assets in the long term. The reason most people don't invest in stocks is due to the volatility. They are very volatile. But in the long term, rest assured, they will outperform everything because they are productivity producing assets and therefore directly contributing to your country's GDP.
All right, so let's try to get something clear and out of the way here first. So we're saying that in the long run, stocks are profitable, right? You are likely to have a capital gain if you invest your money in stocks. So that's point number one. Point number two, they're more volatile. So people are less likely to feel comfortable looking at unrealized losses in the short run and not having that kind of outlook into the future for that appreciation over time. How do you go about choosing the stocks you want to invest in to make sure you make the right choice?
Right. This is going to be a whole topic in another episode. But what I'm going to leave for now...
I tried, guys.
What I'm going to leave for now is that there are two main considered ways of investing in stocks. One is growth investing, and that is looking up companies that have high potential for growth. These companies have high PE ratios. These companies have high potential for increasing their return, but their profit margin are not that good as yet because they are yet to go through that transformation. They are companies that we can look at them and see the future. So those are the Teslas today, those are the Squares today, those are PayPal, all of those companies. Then,
so you're a big Elon Musk guy, right? You mentioned pretty much all of his companies right there.
Well, yeah, that's true. Force of habit, I guess. And then...
No bias here, guys, no bias.
Okay, let's put another company. Netflix, okay? I'm giving you Netflix. Maybe Amazon still is a growth company, even though it's one of the biggest ones in the globe. And then the other type of stock investing is considered value investing. Widely well-known due to Warren Buffett is what he preaches, and that is getting companies that have a lot of value to give, that their cash flow are really predictable, their PE ratios are low, and they've already gone through that transformation of achieving high profit margins on their revenue. Their revenue, conversely, are not really expected to go up that much. So those are companies like Mondelez, Kraft Heinz, Unilever, Procter & Gamble. Those are companies that you probably have around your house.
Yeah, that's true. And I guess the difference here is that you're not really looking for that potential, that growth that may be incoming, but you're looking for stability. You're looking for an operation already structured that's going to give you, dividends, and it's going to continue to grow over time.
Well, that's right. Because the first rule of investing is don't lose your money. And those companies, historically speaking, are very hard to lose your money.
Absolutely. That's a great point.
So how about now we talk about another investing asset. So Raf, I would like you to talk more about real estate because I can see a lot of people on Instagram, TikTok talking about real estate.
Well, I don't know about that. I'm not huge on social media, especially not TikTok and those types, but I'd really like to point out real estate investment trusts, REIT, in short for its acronym. Basically, what you're doing here is purchasing property in fractions. It's very similar to becoming a partner when you acquire any kind of stock for a company in the marketplace. But basically here, you're buying any type of income producing property in the click of a button. So similar to how we highlighted here in the beginning of this episode, how you can go and buy fixed return assets through your bank app. Here, it's not much different. As with stocks, you can basically become partner and buy a piece of paper, digital paper that is, and become a partner for these real estate investment trusts where you're paid dividends or the so-called rent for these options on a monthly basis in most cases. Sometimes it's a quarterly payment, biannual, and so on and so forth. And sometimes you're also looking at the possibility of that being a tax-free type of income. So essentially, what's the difference here? between real estate investment trusts and, for example, fixed return assets or even stocks, you're guaranteed to have some kind of monthly, quarterly, biannual compensation through a dividend payment, which in most cases is always tax-free. Not for all countries. You got to make sure you know how the tax environment that you're in works. But at the same time, it's less volatile than stocks, right? We're talking about any kind of property from where you build a mall today, where you have all these huge warehouses, where you have any kind of companies located downtown in a big city and things like that. So you're looking at really different places where a lot of money is being put into. And historically, just like stocks, you're looking for an increase in market value in the long run. You're not likely to lose money in this kind of investment, but again, you are volatile to some kind of unrealized loss in the short term as always. So what's the benefit here at the end of the day? You're likely to receive that rent or that dividend on a periodically basis, and you're less volatile to unrealized losses in the short term.
Okay, so in a nutshell, does it mean that instead of buying a whole apartment and trying to rent it out or sell that apartment for a higher price, I become a minor shareholder and buy a piece of that apartment?
Absolutely. So that's a great example, right? Maybe something easier to grasp using an apartment, but you can also be a part owner in a shopping mall or in a different, kind of business. If you're looking at a warehouse business, if you're looking at anything like that.
I think the funny thing here is that a lot of people think that they need money to start investing. But here's a very clear example that actually you don't need that much money just to become a partner in a real estate investment.
Absolutely. That's going to be part of our lessons learned today. I mean, you don't need a whole lot of money to start investing today, and that's the beauty of it.
Yeah. Right. Shall we move on to the next asset?
All right, I'm excited. Let's do it. What's next?
Next is commodities. So if you want to add leverage to your portfolio, the way to get it is either through leverage funds or leverage commodities. So this is for more advanced investors. So we just mentioned that they actually exist, but we won't go through it more thoroughly. But I think what we can do is split up the commodities by the 3 types.
All right, sounds good.
So the first one is leverage commodities. So you use options contract to guarantee a price in the future of corn, sugar, coffee, or even cows. So it's, when you usually invest, you invest in a number 1 to 1. So if you invest $100, you're getting the leverage of $100. But whenever you do options contract with commodities, for instance, you are investing $100 to receive $300, $600. You're buying a leverage contract, and therefore it's riskier.
All right. So if I understand that correctly, would that be the same as, hedging for the future?
Some people use those option contracts in order to hedge. So let's say I'm McDonald's and I sell chicken, and I want to guarantee that the price of chicken stays constant so I can plan my cash flow in accounting terms. A way of doing that is through commodities options pricing.
Okay. In other words, yes.
Number 2, unleveraged commodities. So the main examples here are precious metals such as gold, silver, platinum, which appreciate in price when times are uncertain, as they're called hard assets. Okay?
All right, that's fair.
You probably heard about those assets, and you probably have.
Are there any other examples that you could give aside from metals, or is there a specific group that would enlist here?
Yeah, I mean, metals are classic, but you can think about whatever you have in terms of
wood, for example.
Wood, yeah, agriculture. Even farms, you can put all of those
minerals in general, and so on and so forth.
So things, the thing here is things that are not easy to obtain, but they have some value in society.
Right on.
Right. And then the number 3 is collectibles. So those are your Picasso paintings, your famous sculptures, great art in general. Those are your Rolex watches, your luxury cars, your
Don't say yours.
boats.
I don't got any of those.
Even Pokemon cards.
Wow.
right?
All right, there's a taste for everything here.
Yeah, you can go on eBay and see whatever actually is selling at a high
price. Those are ridiculous. They go for a whole lot of money. And it's Absolutely. Not just Pokemon too. You've got all different kind of enemy cards there. Yeah.
Absolutely.
Oh, baseball cards in the US are a huge thing too.
Yeah. Things that appreciate in value because they are rare.
Absolutely.
Collectibles are usually the main way that the rich reduce their capital gains taxes, but this is a subject to another episode.
Yeah. Okay.
Right. Shall we move on to the next?
All right, let's do it.
The next is private equity. So, not to the beginning investors, but we want to give you a glimpse of what is possible. Private equity consists of buying up businesses, making them more profit by increasing their profit margin and turning them around for a profit. The companies that do that are like Blackstone, BlackRock. They're very well known for doing that behind the scenes.
So I guess just to make sure here, this is not really the kind of investment for everyone out there. It's just we're highlighting what that is, but it's not something you dive into on a regular basis.
That's right. That's right. The next one is also a bit more advanced, but more tangible to the real people. It is venture capital. Venture capital is considered the risk of them all, which is funding startups that may become a unicorn and 100x your money, with very classic examples such as Uber, Airbnb, etc.
Yeah, that makes sense.
But venture capital doesn't need to be just on the startups. You can venture capital a bakery in your local neighborhood. This is all called venture capital, which is
right. It's when you have the angel investor that'll boost your business.
Yeah. So in summary, with stocks, you're getting the highest returns, but you usually need to have a long-term vision due to the short-term high volatility. You don't know what will happen in stocks in the next year or two, but you can be sure that in 20 years you get the best returns in the market. And private equity and VC is very highly related to stocks, so you think about them in the same way. Now, I think to add some matter to this conversation, we want to turn into personal life examples, right? So I'm going to pass on to Raf because I want him to talk about investors' profile and how to recognize what sort of asset you should choose.
All right, then. So basically, up to this point, we've talked about different kind of investments that you can make. We haven't necessarily gone very, very deep on the specifics for all of them. That's something that, we want to get your feedback on and maybe prioritize how we're going to go into these specifics with you in the future. But first and foremost, as Vinny just mentioned, it's very important that before you start investing your money, that you understand what kind of profile you have and what kind of risk you want to take, right? So first and foremost, through my own experience, I've learned that it is especially important to understand that risk and reward relationship when you're looking to invest your money, your time into these things. Nowadays, the norm is that there are 3 different investor profiles out there. So let's take a quick look at them. Number 1, you have your conservative profile. What is that? It's the profile of an investor that feels less comfortable with risking over half of its capital in higher risk type investments. So it's a profile more suitable for a fixed return option, for fixed return assets that is, and less volatile options in general. A recommended portfolio, for example, would consist of at least half of its capital into fixed return bonds, for example, and the other half distributed into very stable real estate investment trust, for instance, and stock options as well. Let's look then at number 2 then, all right? So number 2 fits into a slightly different profile, which is called a moderate profile. What is that profile like? It's an investor profile comfortable with some level of risk. What that means is that, it's okay to have some volatility in the short term when the actual goal is to obtain a capital gain in the medium long run. All right, so an appropriate investment portfolio here in this scenario would consist of about 25 to 35 of its available capital into a fixed return asset or different fixed return asset options versus, roughly the rest there, 2/3 of it in variable income options, such as the stock options or even the real estate investment trust, for instance. That would offer a higher risk reward scenario here and potentially, increase your gains over time. Last, we have the aggressive profile that, we could dive deeper here and go very aggressive, highly aggressive, ultra aggressive, and so on and so forth. So this is the type of investor which is on the other side of the spectrum here. This is an investor who tolerates a high risk, high reward relationship with their portfolio. In practice, this means that only a fraction of investments will be allocated to the fixed return asset type, about 10% max usually, while the other 90% will be in variable income from stocks, real estate investment trusts, commodities, and much more. This tends to be the profile for most senior investors, or at the very least, those who are experts and feel very, very comfortable with unrealized losses in the short run, estimating then later gains in the long run exclusively. All
right? So we talked about 3 different profiles. In summary, conservative, moderate, and aggressive.
That's right. So basically we're talking here, if we're making a little ladder to explain, conservative being at the bottom, willing to go with the least risk possible, moderate being in the middle, assuming some level of risk, and last but not least, we've got the aggressive profile, which is comfortable assuming a lot of risk with a high risk, high reward relationship. Vinny, how do you assess these profiles and how do you fit into that these days?
Well, as with most people, I've been on a journey with my own investing career. So when I was younger, I would say extremely aggressive. Now I'm probably on aggressive type. And I believe that gradually I will be shifting towards moderate.
Lots of lessons learned in that journey, huh?
Yeah, absolutely. What about you, Raf?
I have a moderate profile nowadays. I currently have, 45 to 50% of capital invested into fixed return products, and the rest is allocated exclusively between real estate investment trust and company shares, so on and so forth. Particularly for me, this is a profile that suits me because I want to perform better than the bottom line, but at the same time, I'm not comfortable with all my capital being volatile to high peaks and valleys. So that's just my personal opinion, all right? So there's no right or wrong answer here. I feel like it's a matter of diversification for everyone, independent of which profile suits you best. Just making sure that you're allocating capital in different investment types, industries, and so on and so forth. There's a lot to consider, but there has never been so much free information on the subject as there is now. So anyone can definitely learn about this subject and become a good investor over time by putting in the work. That is what it's all about.
Yeah, absolutely. I agree with that. And another thing to realize is that the definition of these profiles may change depending on the economic environment that we are in. So, for example, nowadays with the interest rates close to 0 worldwide, you would be a bit naive that you have most of your portfolio in bonds, as they are paying almost nothing in most of the developed countries. Thus, a smart, moderate investor in 2021 is an investor that doesn't have that much money in bonds as in normal times. So a lesson here is that interest rates and inflation force a move towards aggressiveness in most portfolios.
Absolutely. I totally agree with that. And I guess, I want to put a big asterisk on this, just, based on experience here. We're talking about different types of investment profiles here. And you just gave us a bold sentence here, right? That, for example, nowadays, a moderate profile investor will be likely to be shifting his or her investments into, more of a tendency of an aggressive profile. However, I would like to say that, depending on where you live and what the conditions of the local economy are, that really depends. I'm just going to give an example talking about Brazil, for instance, right? Here we're talking about an economy that doesn't really go into that close to 0 interest rate in that worldwide definition, although it did change historically within the past 2 years. We didn't go to zero, but we got pretty close to it, historically speaking, to what the rates used to be. However, we do see already a difference recently in 2021 as this rate has started to increase once again. So for those people that have that kind of conservative profile or moderate profile, they would already start to feel the opposite effect, start to feel comfortable once again to leaving their money into some fixed return asset products. However, that gave a lot of people the confidence to really start investing in different types of investments and learn along the way. So today you can see that, you got both worlds going on.
Yeah.
All right. So basically we've covered a lot of stuff here. We're going to go into a lot more detail in future episodes, of course, but from what we talked about, what are the main takeaways here for today?
Well, the lesson here, I think, is self-awareness. So self-awareness is key in everything in life, including when investing. So whenever you open an investing account, most brokers will request you to complete a questionnaire to find out about your profile.
Yeah.
However, it's really hard to understand how comfortable you are in a market downturn if you've never experienced one. A suggestion here is to practice, either by putting your money in the market through a small account, or by virtually playing with the market in those investing apps that gamify for you, or simply thinking about situations when you gamble away your money, like in poker or in the casino if you have that experience, or when you have lost cash in unexpected circumstances. All of those examples will show you your true reaction when facing a market downturn.
That's a great point. And that's not something that you're going to find in any bank questionnaire. Is that right? Been there, done that. All right. Well, I do agree with that. I believe that ultimately we are to, first and foremost, be empowered by all the free educational resources out there. There's a lot we can learn from today, and take the first step to understand how it is to invest your money and become accountable to it. We have said, and will continue to emphasize here in our podcast, how important it is to become financially educated in today's world. So the first step really is to simply do better. Secondly, diversifying is key, guys. So just like with anything else in life, you must be able to allocate your resources in different pockets in order to mitigate risks and put yourself in a position to grow your investment portfolio in the long run and acquire that long run mindset, which is incredibly important for business and for life in general. Finally, we recommend to be curious. It's easy to get comfortable and live within the confines of the comfort zone, but it really does pay off to go one step beyond for your investments, as for anything else you do in business or in your path to your own personal growth. It is important to learn about the local market that you live in, tax implications for certain investment types, incentives, and a whole lot more. Investing is not necessarily easy, but it's never been easier than it is today. You can start with a mere $20 and work your way from there.
So $20 is fine then?
Yeah, $20 is great to start. I definitely started with less than that. Don't miss those days.
Wow.
Vinny, I have some bad news, man. We're running out of time today. It's time to wrap it up. That went by fast, didn't it?
Well, tell me about it.
All right, everyone. Thanks again for tuning into the Compound Show today. We appreciate you being here with us today. Please send us your comments, questions, or suggestions via thecompoundshow@gmail.com, and we'll get back to you as soon as possible. Be safe and be great, everyone. Till next time.